Japanese banks had some of the biggest stock price impacts on the day, um, but it's really a pretty broadly diffused trade. There's just a number of entities that had to deleverage that would have taken some pretty significant P&L hits on that day. And we've already seen a pretty sharp rebound,
Yeah.
um, but because a lot of that is now deleveraged, but there are kind of broader issues associated with it. Well, I would phrase it a little bit different. I think a lot of people, I mean, when the yen was weakening, people were saying, "Oh, it's the end of Japan. All the stuff's kind of coming back to hit them now." And then, ironically, when we had this period of yen strengthening and the Nikkei down, people are like, "Oh, it's the end of Japan. All their stuff's coming back to hit them." It's like, well, what is it? Is it when it weakens, is it bad for them, or when it strengthens, is it bad for them? Like, what exactly are we calling, the crisis here?
Japan's stock market recently plummeted by 12%, sending shockwaves through the financial world. But is it really the crisis everyone fears? Lyn Alden dives deep into the numbers, revealing that this sharp decline might be more of a mechanical shift rather than a true economic catastrophe. With the yen swinging between weakening and strengthening, Lyn challenges the narrative of a looming crisis, instead suggesting that global capital flows could soon shift away from U.S. markets. As the U.S. faces potential economic headwinds, could this be the start of a new global financial landscape?
Um, I view this individual instance as less big of a deal than many market participants made it out to be, which is to say that this was a fairly mechanical shift. Um, there was a deleveraging that happened. There's probably more deleveraging ahead, but less abrupt because now the pivot is in place. Now the trend change is more obvious. Kind of like the fear of God has been put back into anyone who was running a leveraged book. Like they're reminded, yes, there's risk. Yes, kind of like changes psychology in the market. Um, and I think that I think Japan still has a big runway ahead, and all the different levers they can pull. Their stocks are not particularly expensive, right? So it's not like you're in the late '80s when they got their famous Japanese bubble. The valuations were silly back then. Whereas now the stock market is fairly reasonably valued compared to their cash flows and things like that. So it's not surprising that when there's a 12% drop, there's a number of people that say, "Wait a second, most that was almost entirely mechanical." So I'll go in and buy names that are inexpensive and oversold. There are unlevered entities could come in and take advantage of the fact that levered entities basically had to sell. Kind of like if you see a Bitcoin get a liquidation, if you're unlevered and you have some cash sitting around, some people will come in and buy it. So we've seen some of a rebound in Bitcoin as well. Um, and so I think that's normal. I think the bigger story is that aside from just the carry trade, the way that global finance works is that most currencies trade against each other based on interest rate differentials and current account flows. So if you're running a structural trade balance and your interest rate's not attractive, your currency is likely to weaken until you kind of find more of an equilibrium. The dollar has this extra monetary premium on top of it. As the most liquid, most attractive currency in the world, the deepest capital markets, there's a lot of entities around the world that hold dollar denominated assets. And so we get like a structural premium to our currency, which makes us really good at importing. We have tons of importing power, but it makes our exports less competitive. And so to meet that kind of global demand for dollars, we're kind of forced into running these structural trade deficits. And they accumulate over time. More and more dollars flows out into the world. They take those dollars and they buy U.S. assets. And so everybody's kind of crammed into our stock market and our bond market and our private equity market and our real estate market. Everyone's kind of crammed in, but especially equities. Um, and so it's like a really kind of an engine that just keeps spinning. And there's a decent chance that can start to reverse in the years ahead. That as our economy slows down a little bit, as the weak exports weigh on our GDP, as there's rising political concerns around that trade deficit and the broader concept of reshoring and kind of actions we might take in terms of currency or in terms of trade to try to reduce that, you could get a partial, kind of flow out of that capital, which would be benefit some countries, but would harm others. And I think that we're probably on a setup like that. The last time we actually had a setup like that was after the dot-com bubble, when the U.S. cut interest rates. In the late 90s and early 2000s, the dollar was very strong. And there was the Asian financial crisis because they all had dollar dominated debts. A lot of them blew up. But when our economy softened and we cut interest rates, It kind of gave especially the developing world, more breathing room on their liabilities. And so, from say 2003 to 2007, there was an emerging market boom. That's where we actually got the term BRICS from. Everyone was like this, that was kind of hot trade. That was like the Mag 7, or like that was the main trade of the day, was these booming emerging markets. And maybe on a smaller scale, we could get something like that again, which is if the U.S. finally runs into some economic headwinds, trims interest rates. Some of this capital that is just so on one side of the boat, so stuffed into U.S. markets, could start to come out and go to certain pockets of the globe where things are cheaper, where their dollar diamond debts are now like under control, and you can start like a virtuous flywheel into those types of areas.
In 2019, the Federal Reserve's decision to cut interest rates briefly opened the door for a market rotation, a chance for capital to shift from U.S. markets to more balanced global opportunities. However, the pandemic quickly closed that window. Now, according to Lyn Alden, we're seeing signs of another potential shift. As the U.S. economy softens and interest rates could be cut again, we might witness capital flowing out of the U.S., leading to higher energy prices, inflation, and challenges for American consumers. Meanwhile, other economies could find relief and growth. These imbalances in the global financial system are reaching a breaking point, and a significant rotation could be on the horizon.
Yeah, I think basically it's more dangerous when you're in a very imbalanced condition. And so then the question becomes timing. There have been a lot of people calling for a rotation and a mean reversion of that trade. The last time there was a good window for it was 2019. That was the mid 2019. The Fed started cutting rates, so it was before COVID.
Yeah.
The U.S. economy was already softening. The Federal Reserve cut interest rates by late 2019 because the repo rate spiked. They actually went back to balance sheet increases as well. Um, and so, and you started to get this kind of mini, the dollar weakened a little bit. You started to get a little bit of a mini rotation into some foreign markets, but then COVID and lockdowns and everything. So that rotation never really materialized. A lot of countries were hit harder than that, especially developing ones, because of all the effects of that whole situation. And so this is probably the first window since 2019 where a serious possibility of rotation is at hand. And it's hard because you don't want to be, early. Like, in my base case in 2019 was, okay, look, we're probably going to get a rotation. Then, of course, the pandemic happens. You got to change all your outlooks. So there are certainly things that could derail that view. I do think a rotation would be healthy should it occur. Generally speaking, when you get that kind of rotation, so in the prior times where we had that kind of rotation, in addition to being good for those select foreign equities, it also tends to be good for commodities, gold, and presumably Bitcoin. Bitcoin was not around in prior rotations, but presumably it'd be good for them because you generally have a weakening dollar, and kind of just capital more broadly dispersed and a little bit of a boom. It can be bad for American consumers, right? The ones that have kind of been on the winning side of a lot of things. You can kind of get more inflation in the U.S. You can get more higher energy prices in the U.S. It's kind of like a band-aid being taken off because it does increase our export competitiveness to some degree. Um, so there are kind of winners and losers from that. But basically, if you're a foreign exporter, it might not be amazing, and if you're an American consumer, it might not be amazing. But it's kind of so imbalanced right now in favor of foreign exporters, and in favor of American consumers, and it kind of reaches like a breaking point eventually. And those groups generally will not love that type of period, whereas anyone who's a consumer in all these places with weaker currency, they generally do better, and American exporters could maybe not do amazing because we've got structural issues there, but they could get breathing room. For example, all else being equal, it's some tailwinds in their favor.
Um,
That's true, but it's on a relative basis. American consumers have generally done better than other countries, especially when looking at global purchasing power. So, for example, our ability to buy energy has generally been better
mhm.
than, say, a Japanese person's ability to buy energy,
Or
um,
I was over here.
or yeah, or Americans' ability to travel abroad. It's easier for us to go to Japan or go to Europe than Europeans or Japanese to come here, let alone emerging markets. Um, and so, especially on the upper half or upper third of American consumers, that's where a lot of the strength has been focused. and they could take, a fairly big hit. That if you have a cycle of capital outflows, and again, I don't think it's going to happen overnight, but if you do get one of these more sustained flows, like we did in the early 2000s, um, a lot of those kind of upper middle class American consumers that have been able to fly everywhere, buy whatever they want, energy's cheap. Um, some of them run into issues, and unfortunately, it will also impact some of the lower income consumers that have already not been in great shape. And so that's the type of where there are winners and losers. Now, some of those lower income consumers could be offset by the fact that there's more exporting jobs, for example, maybe more manufacturing things like that. So more opportunities for income, but also damaging to their consumption. But at the end of the day, a lot of this isn't really intentional. It's just kind of like imbalances in the system potentially reverting back when they can no longer be sustained. Like when the rubber bands stretch really far and you're trying to hold it and your muscles are getting tense, eventually it just kind of starts to you kind of let go. And that we could see something like that ahead. I'm kind of monitoring for signs that as the U.S. cuts interest rates in face of a at least somewhat softening economy, I'm going to pay attention to really how that affects some of these dollar indebted countries that have otherwise held up pretty well, but that are kind of under the boot of a strong dollar.